Welcome back to the Global Ledger. I'm Justin. Episodes 20 through 27, we explored the institutions that make the money markets work. We talked about dealers, money funds, clearinghouses, and the global coordination. Today, we're turning inward into the architecture of the modern banking system and into one of the, I'd say least understood aspects of how banks operate. This is Basel regulations and capital constraints. You've heard people say banks lend out reserves, the Fed controls lending, QE should cause lending to explode. None of that is true. Basel is the real constraint. Capital is the real constraint. Risk-weighted assets are the real constraint. And we're going to explore what Basel actually is, how capital rules work, why they limit lending, and why banks prefer certain assets over others. So this episode will completely, hopefully, rewire your understanding of how modern banks actually operate. Let's get into it. Let's begin with the basics. Basel refers to a series of global banking standards designed by the Basel Committee on banking supervision. You have Basel I, II, III, and now IV. They were created to ensure banks hold enough capital, manage risk properly, and avoid collapsing the financial system. But here's the key. Basel doesn't regulate liquidity. Basel regulates capital. Capital is the buffer that protects depositors in the system when loans or securities lose value. And capital, not reserves and not deposits, is what limits bank lending. So let's be extremely clear on something. The public, I think, always misunderstands. When a bank makes a loan, it does not use deposits. It does not lend reserves. It does not multiply money through fractional reserve banking. Forget the old textbook kind of thing. Here's what actually happens. The bank creates a loan. The bank simultaneously creates a deposit. The bank's balance sheet expands on both sides by the same amount. This is balance sheet expansion, not reserve usage. So what stops the bank from doing this infinitely? Capital requirements. Not reserves, not deposits, not the Fed, capital. So what is bank capital? Capital is not cash. Capital is not money in the vault. Capital is not reserves. Capital is simply assets minus liabilities. Equity. It's equity. If the bank's net worth, and that's important, it's the bank's net worth. So, and Basel requires that a minimum amount of that equity must exist relative to the bank's risk-weighted assets. Which brings us to the heart of the modern system. And that's kind of the hidden constraint, risk-weighted assets. So every asset on a bank's balance sheet is assigned assigned a risk weight, I should say. So examples, 0% risk weight, Treasuries. 20% risk weight would be agency MBS. 50% mortgages. 100% corporate loans. 150% and plus risky assets, some CRE loans, or subordinated debt. This means $100 of Treasury counts as $0 of RWA, which stands for risk-weighted assets. So $100 of mortgages counts as $50 of RWA. And $100 of corporate loans counts as $100 of RWA. You just kind of see the picture here. So total RWA rises when banks take more risk. So the rule is capital ratio. That capital ratio equals capital divided by the risk-weighted assets, RWA. So banks must keep this ratio above a minimum threshold, often around 10 to 12%, depending on jurisdiction and buffers, of course. But so if a bank adds $100 of risk-weighted assets and it needs 10% capital against that, the bank must have $10 of equity. If it doesn't have that equity, it cannot make the loan. This is the real system constraint. So why do banks prefer some assets over others? Here's where the Basel begins to shape the entire structure of markets. So banks love treasuries, they love MBS, and they love high quality loans. And now we have to keep in mind the risk-weighted asset and the percentages that are tied to specific instruments, assets. So banks hate those subordinated corporate debt, you could say, risky mortgages, construction loans, unsecured lending, long-term illiquid loans. And the reason for this is because some assets cost capital and others don't. So if a bank has limited capital, it will choose the assets with the highest return per unit of RWA. This is why banks often prefer to buy treasuries. They prefer to originate safe mortgages, do low risk lending, and leave riskier lending to non-banks, aka shadow banks, shadow lenders. So Basel literally reshapes the economy. So what happens when capital runs out? When a bank cannot meet its capital ratio, it must stop lending, it must raise equity, it must shrink the balance sheet, it has to sell assets, and it must avoid at all costs taking new risk. So this is a credit crunch, and it can happen even when reserves are abundant, deposits are flowing. The Fed is easing, interest rates are low, and this is why QE doesn't automatically increase lending. Banks don't lend reserves, they lend capital. So how did Basel become global? Banks all over the world must adhere to Basel rules because large banks operate globally. Cross-border lending requires standardized rules. Risk in one country affects others, and regulators want to avoid another 2008. Basel is, in a sense, the global governance layer for bank balance sheet risk. And because banks are central to global money creation, Basel indirectly shapes global credit, global liquidity, global valuations, and global financial stability. And so the global dollar system is a dealer system, not a banking system. So because bank behavior is now so heavily regulated and capital so constrained, shadow banks often supply the marginal credit. How does Basel interact with markets? What rules do they affect, I should say? So let's start with treasury demand. I think that's probably the one of the best ones to start with. Of course, banks love treasuries because they are 0% risk-weighted assets. And so that would affect the treasury market. Having this percentage attached to it, you could say in simpler terms. The repo market. So treasuries become a high quality collateral, vital for funding. Basel rules affect credit spreads. So high risk-weighted assets must provide higher yields to compensate banks. Another one would be securitization. Banks push risky loans off balance sheets to reduce this risk-weighted asset. And so another one would, of course, be dealer balance sheets. So capital rules constrain market-making capacity. And of course, market liquidity. So, you have tighter capital, fewer dealers, more volatile markets. And you can't understand modern markets without understanding Basel. It's really important. And understanding Basel removes misconceptions, and you can start, you can understand capital constraints. Banks lend out deposits that, stops making sense. QE causes inflation, becomes simplistic. So these are the kind of things that are important to remove some of these false beliefs about the world. So Basel is the silent architecture behind this modern way of banking. So it explains post-2008 slow lending. It explains dealer balance sheet shrinkage, repo fragility, and explains why Treasuries are the ultimate asset. So this is the backbone of the modern system. Thanks for listening to episode 28 of The Global Ledger. We covered the invisible structure that governs modern banking, Basel capital rules, and risk-weighted assets. Without understanding Basel, I don't think you can understand lending, credit, liquidity, or even risk. In episode 29, we're moving to the global layer. We're going to talk about central bank swap lines and why the Fed became the world's backstop. This is where global money meets global power. Once again, I'm Justin, and thanks for being here.